Andrew, good having you. Thanks much for joining in. In a world which has enough and more dovish central banks, while the world markets are scaling new highs, the emerging markets not so much. What explains this dichotomy? Because it's not just India. A clutch of other EMs are seeing some fund outflows and some pullbacks. How do you look at this dichotomy?
Well, I mean, here we are in China and Hong Kong. We're actually seeing markets, seeing some stabilization from the data coming out of China. And interestingly, I think people are more confident that the trade conflict with the US is settling, and that's giving some confidence to some of the markets. But obviously, where we've got movement in the US dollar, that puts a lot of pressure on a number of those emerging markets in the meantime.
Since you were talking about China, what have you read into the various data points that have been coming in from there? We're talking about the economy slowing at its weakest pace since the time these quarterly data was available. Gross domestic product 6.2%, traces of what's been happening because of the trade tiff. How would one read into the indicators from China and therefore the repercussions for the rest of the emerging market back?
Well, I think the data that we saw that came out after the market on Friday on loans was maybe a little bit weaker than we'd expected. But again, the government house pricing this morning was again a little bit weaker. But that's a fine line for China. It needs to keep that housing market going, but it's very conscious that it doesn't want a bubble there. And then later, about half an hour later this morning at 10 o'clock, we got the GDP number, which, as you say, 6.2, very close to what the analysts were expecting at 6.3. And I think a lot of people viewing that as being signs of stabilization coming through. And obviously, we've had comments recently from the US about face-to-face talks on the trade talks. And people are taking that very much more encouragingly than they did last time, because we're not seeing the tweets from Trump. We're not seeing comments out of China. The whole thing seems to be being handled in a much more professional way, with negotiations going on behind closed doors and hopefully an agreement getting reached in the near future. And obviously, if we do get that agreement, that's going to make a big change to a lot of these emerging markets. Obviously, we don't know the detail of that agreement, but the likelihood is that it means that we'll see stability coming out of China. We'll see more growth in the emerging market area. And generally speaking, we'll see more confidence from investors, which should draw money back in again.
And to pull that point a little bit further, they had a better than expected retail sales data also, which led credence to the fact that stability could emerge, or rather will emerge, in the second half of the year as well. Andrew, what does this do for emerging market currencies and equities?
Well, I think for equities, they have been the sort of, as you were saying earlier, relative to the US, we've seen market being taken out of emerging markets and returning back to the US. But I think as we approach the earnings season in the US this time, we're going to see, and people are going to be watching for, what's the effect been on margins from this trade test, and really what's been driving these stocks markets higher. It's not really, I don't think, end demand. It's been a lot of share buybacks. It's been the tax concessions that we saw last year. And I think as people start looking for growth again, then some of the emerging markets are going to provide them with good opportunity. Now, obviously, as well, if we see the Fed cut interest rates in the US, that's going to put the dollar in a weaker state. And again, that's going to help some of the emerging market currencies.
Andrew, what's the view in India? Because last 9 sessions, we've seen outflow coming in from the FPI community, and with the fine print that has emerged from the union budget, which came out on July 5th, has sparked some concerns with regard to FPIs, which are listed as non-corporates, would also attract higher surcharge. So any thoughts on that, and thoughts on India, because we've seen a lot of outflow in the last 9 sessions?
Yes, I think people are a little bit worried about the wider economy there. And as you were saying, there are concerns in the press about the state of the housing market and the developers. There's been some concerns on the banks there. And all these are flags to a number of the foreign investors who want to be, cautious in these markets at the moment. A lot of them are already sitting on quite a lot of cash. So they want to make sure that the investments that they make are are sound investments, which I think is probably why, to a large extent, we're seeing more activity in the larger cap stocks rather than in some of the small mid caps, which typically is where these funds would look to try and get their outperformance from. So I think, we've got this caution that is running wild at the moment just because of some of the concerns on some of the parts of the wider market.
And in terms of capital flowing into different economies of emerging markets, and also keeping in mind that from the recent testimony of Fed Chair, which has indicated, of course, we'll be waiting out for the US retail data, that there could be a rate cut happening this month. If that were to happen, and if the capital has to flow from developed to emerging markets, which are on top of your mind, the countries which can attract more capital?
Well, I think if we're seeing stability, if he cuts the rates and we're seeing stability in China, then I think a number of the emerging markets in Asia should benefit. The slight flip side to that, I guess, is the fact that we do have that trade tiff between Japan and South Korea, which is causing some concerns in the tech industry, certainly in South Korea. But we've seen some good data out of Taiwan recently, and that could attract some more interest there. And as I say, especially if we're seeing that stability coming through from China on the tariff wars, then a number of these ones will, from the supply chain side, start to be looking very attractive. And of course, because of the trade war and the tariffs, we've seen a number of companies looking at diversifying their supply chains to the benefit of countries like Vietnam, Cambodia and Indonesia. So again, those countries might be ripe for some new investment going in.
Andrew, so in light of that, if you had to have a pecking order in terms of preferences of countries within the Asia-Pacific region, I would include Japan in that, because of late, we've been seeing a lot of positive commentary regarding investment environment in Japan as well. So what would the order of preference be? I mean, if you have to stack up between Japan or China, India and Indonesia, and Malaysia and the rest of the pack?
Well, certainly, I think Japan, we've seen a lot of encouraging signs, as you mentioned there, and it's a very liquid market, so that always makes it very much more attractive than some of the other markets in Asia, just on the amount of capital that it can absorb without having too much influence. I think China, we have seen, that certainly the A shares and the H shares have been under pressure, and they've had a bad couple of weeks. So, that's mainly retail driven rather than foreign investment driven. The foreign investment into China, into the A shares, tends to come from index trackers. And obviously, we're looking at the FTSE and the MSCI increasing their weightings over time. But I think a lot of investors will wait for those weightings to be increased. So that brings us then to probably Hong Kong as a proxy on that. And certainly today we've seen higher flows than we've seen for quite a while, I think. But we're still running, today was about 73 billion. Historically, this market has run anywhere from 85 up to 120. So there's still a lot of scope here. And I think the same goes for a number of the emerging markets that are linked to that. You can look at Taiwan, South Korea. As you were saying, India is always a healthy sized market that attracts investors. Then people will go down to the smaller markets, but liquidity in those markets and having the opportunity to invest in stocks with size becomes more difficult.